Friday, March 22nd, 2019, Maneco 64, home of alternative economics and contrarian views. This morning I want to talk about commodities, the CRB index, inflation, hyperinflation, and the major difference between the two terms. And I'll also quickly go over this book that I highly recommend for my new subscribers, for those who haven't looked at it. It's called Fiat Money, Inflation in France, How It Came, What It Brought, and How It Ended by Andrew Dixon White. It's a real classic that you need to read, and in my opinion, gives you an idea of what's happening today in terms of the monetary system and what could happen in the future. It's not a long book. There's a lot of free PDFs online. Before I go into commodities and the book, let's have quickly have a look at what the markets are doing this morning. 7:37 a.m. London. Yesterday, of course, was an interesting day, to say the least. On Wednesday, the stock market finished down 140 points, even though the Federal Reserve backtracked. And then overnight as well, pre the open yesterday in the futures market, the market was down even more. And then we opened and everything rallied. So that's, I think, most people that don't follow the markets like we do, they will not care that the market dropped right after the Fed announcement. They'll see what happened the day after that. The Dow was up 200, S&P was up 30. So they'll think, oh, that was good for the markets. They won't look at the initial reaction of markets to announcements, which usually should be, there's a rule in the markets that when you get a economic number or a central bank announcement, the initial move is usually the move that you should get. Of course, we can always speculate what happened yesterday with the stock market. I have three letters that I can think about, PPT. But anyway, let's see where we are this morning. Spot gold is up $2.50 at 1311.65. Overnight range has been 1307 to 1313. Silver is up 6 cents, 1552. Near the highs of 1556 overnight. The low has been 1542. So precious metals are stabilizing. Yesterday we got up to 1320 before the US opened, and we got the huge rally in paper assets. And of course gold then drifted lower, got a further hit lower late in the day to like 1303. But that was also because the pound dropped a lot and the euro dropped a lot. So it was a combination of things. Right now, yeah, so what about the stock markets? The Dow is down 11, just below 26,000. S&P unchanged, and the NASDAQ 100 future also unchanged. So fairly quiet so far. We'll have to wait until we get near to the open to see what happens. Currencies. Sterling has rebounded a little bit. It had a big drop yesterday, over 1%. We're now at 131.36, up 0.25%. Cable. Euro is up 10 at 113.84, and the dollar is down marginally against the yen at 110.76. Dollar's back up to 670 against the Chinese yuan. So yeah, I think the recent low was around 666 or 67, thereabouts. Crude oil, WTI is still holding above 60 here, 60.05, and Brent is at 67.76. Both kind of unchanged, so fairly quiet. The bond market, while the yield curve looks very interesting, of course, the 10-year yield right now is down 1 basis point at around 253. But the more interesting thing is now that if you go from the 1-month T-bill, which is yielding 247 right now, to the 7-year, which is yielding 243, that's inverted there, all the way from 1 month to 7 year. I think it will be just a matter of time till we see it inverted from 1 month to the 10 year. So some people have asked why are rates, longer term rates lower than the shorter term rates. Well, it's because the investors have lost confidence that the economy is going to do well in the longer term. So they've driven up the longer term bonds prices higher and the yields lower. And at the same time, the Federal Reserve is keeping rates in the short term relatively, high. They were raising rates until recently, and so that's why the curve is inverted. But it's a signal. It's always been a signal of a recession, an inverted yield curve. So that's what we have to keep in mind. What about commodities? Because we hear, of course, a lot of people in the mainstream, the central bankers, Wall Street, City of London economists saying, people like me and others in the alternative who've read this book and know the ills of fiat money, that it will end in tears, that they keep saying, oh, we printed all this money since 2009 or 8, and there's no inflation, there's no hyperinflation. So first of all, we know there is inflation, right? I talked about the Big Mac index, shadow stats yesterday. The measure of inflation they use is doctored. We know a CPI. It doesn't count all the important things that are rising. It excludes them, like healthcare, housing. In the UK, the CPI doesn't count that. They use other techniques like substitution. So what's substitution? Well, if the price of fillet steak has gone up a lot, they'll substitute it for spam. So, for example, they will also use hedonics. What's hedonics? Well, they'll say, oh, the cars nowadays are much better than the cars were 30 years ago. So yes, the price has gone up, but the improvements actually have gone up. So we will adjust the price, which I think, in my opinion, is complete rubbish, because yes, cars might have more gimmicks nowadays, but cars in the 70s and 80s were just as good. And maybe even if they are better, technological advances should have driven the price of production lower anyway. So we know that they're lying about the inflation. What about hyperinflation? Hyperinflation has, I guess the origins of hyperinflation are in the rising prices, but it's a little different. It's not really cost push inflation, like things going up because the currency is going down. It's a point where the public actually starts losing faith and confidence in the currency because they see it going down all the time, or going, prices going up of goods and services, and they start, the demand for that currency starts dropping, and demands for real goods, tangible goods, starts rising, and that's when you get the seeds of hyperinflation. And it can happen very quickly. It's just a loss of confidence and faith in the currency, which for now, it looks like the major central banks of the world still hold that faith and confidence of investors in the general public. But it could change quickly. And I think one thing we need to keep a close eye on for that is the CRB index, which is the Thomson Reuters Core Commodity Index. And it has 19 components, 19 commodities. And I'll read here from Wikipedia. Aluminum, or aluminium as the English would say, cocoa, coffee, copper, corn, cotton, crude oil, gold, heating oil, lean hogs, live cattle, natural gas, nickel, orange juice, silver, soybeans, sugar, unleaded gas, and wheat. So the important thing to note about commodities markets is that they're very cyclical. What does that mean, very cyclical? Well, it means that when commodity prices are rising, producers will produce more commodities because they're to maximize their profits, which is normal. But then that will lead to oversupply, and that oversupply will eventually drive prices lower. And then vice versa as well. When prices get too low, it will, producers will not invest because it's not profitable and it's not interesting. They'll put their money somewhere else. And then the supply of commodities will dwindle. And then as demand stays the same or even maybe increases a little bit, prices will rise, and then you get another bull market. And that's how commodities work. And I just wanted to show you here that since basically 2008 and the financial crisis, this CRB index has been in a bear market. So it's very cyclical. Some people say that these cycles in commodities last 10 to 15 years. So here we are right now, 11 years later, and we're still in a depressed commodities market, as per the CRB. I think 11 years we've had this bear market in commodities. So we are getting close to a point where these commodities are going to pick up, and the dollar and other fiat currencies are going to start dropping against that. And that's when you're going to get your real 1970s style stagflation. I already think we have inflation. Consumer prices are rising, and also the cost of living is rising. I know, but they're keeping a lid on it. They're basically fudging the numbers. But I think once the CRB starts moving, it will be very difficult for them to do that. So you can see here that the key level really here is just above 200. I mean, we have been above 200 recently. I think it was May of last year we got up to 208. But if you look at the big crash in the CRB during the financial crisis, the low there in 2009 was 200. So that is a key level, 200, 208. If we can get above that, watch out. So at present, we've had commodities that have done really well and others that haven't, and that's kept the whole index down. So quickly to Fiat Money, Inflation in France. Book by Andrew Dixon White. This was written in the early 1900s, and it's basically about what happened after the French Revolution in 1790. Now quickly read here from the back. It says, in 1790, the French people, by general acquiescence, embarked upon what they believed to be a harmless experiment in currency inflation. The results of this action are vividly described in Dr. Andrew Dixon White's book entitled Fiat Money, Inflation in France, How It Came, What It Brought, and How It Ended. So why is this book important? Well, because I think the central bankers of the modern era, well, right now, are making the same mistake. And I could tell when they started QE, because I'd read this book, almost 20 years ago. I could tell that, the QE wasn't going to work, and that once they try to withdraw the QE or, normalize the balance sheet, things would get worse again, and then they'd have to do QE again, and it could never get back to normal. And eventually it would just all implode, and that's what happened in France. So I highly recommend this book. And all the symptoms, gambling, speculation, crime, corruption, all the same. The thing is, it didn't take long for this to collapse in France, about 5-6 years. But right now, the whole world is on this experiment, so it's taking longer for it to really implode. But let's keep an eye on the CRB index. That's quite important, in my opinion. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet, and you enjoy my videos. Share the video far and wide if you think other people would enjoy this kind of content. And make sure you hit the little notification bell above to be notified of all my new videos. You can also follow me on Twitter, Steemit, and DTube. I wish you all a great day. Take care. Bye.